Travis Watts, man, I'm super excited to talk to you on the Capital Raiser show today. I met you at Adam Adams' event. Really good little conversation that we had, and you requested to come on the show, but from the passive investor side, you have been in 25 deals with your wife. We were just talking a little bit before the show about using your self-directed retirement account to invest. Welcome to the show. Thank you so much for coming on, man. I'm really excited about this.
Absolutely. Glad we could reconnect for
Cool, man.
sure.
So on my show, I don't really have any preset questions. However, we'll probably dive deep into the passive investing side. So you had mentioned previously that you were a active investor in fixing and flipping homes, which I see is an avenue for a lot of people to first get their feet wet, and then a lot of times they move into syndication. So tell us, when did that transition happen for you, and what was that like?
Yeah, absolutely. So I started investing in 2009. I started with just a single family, actually it was a condo or a townhome. And I did a whole bunch of different single family strategies over the next several years. I did a little bit of house hacking on the personal side. I did fix and flips. I had a few buy and holds, and I was doing some vacation rentals. The whole intent with me from day one was to be 100% passive in real estate long term. Didn't know how I was going to get there. Didn't educate myself nearly enough when I got started. And I was just kind of trekking down the wrong path the whole time in order to be completely passive. So it wasn't until I had probably a little over, a handful of properties and these various strategies where I realized I wasn't going to be able to scale that. If I ever had that ambition to go to 50 properties or 100 over time in the single family space, I didn't see a reasonable way to scale it after putting some property managers over them and things like that. So I took a step back, and that's really when my education started. So that was, listening to a bunch of podcasts, reading a bunch of books, going to real estate meetup groups. And I kept hearing this word syndication. People kept telling me, have you heard syndication? Have you tried syndication? I didn't know what that meant at the time, but I did a whole bunch of research on it. I did one deal. This was around 2015 or so, and just sat back and watched it for about 6 months. I was a little bit skeptical myself, and just watched the monthly distributions, monthly reporting, and man, I just fell in love with that concept, the concept of scalability. Didn't matter if I had one deal, 1,000 deals. I didn't have to be hands-on. I didn't have to turn over units. I didn't have to manage tenants. So that's kind of when I made that shift, maybe around 2015 or so, into multifamily.
Cool. So you came on the Capital Raiser show, and interestingly enough, I am not able to verify, but I think some of the listeners are actually passive investors that are curious what we talk about here on this show, because we're talking about raising capital. We have a lot of very successful multifamily syndicators, and I think people want to know, what is it that they say on a show about raising capital? How do they look at us as passive investors? I want to make sure that this guy or these individuals that are on the show are saying really nice things about us, since they're basically taking our money into this deal. But so you had mentioned that you're passive investing primarily, or at least you're in about 9 deals with Ashcroft, which is Joe Fairless's group. So tell us, what do you like about working with Joe Fairless? He's a great guy. I haven't met him yet, but I'm interested in going to his upcoming conference here in Denver, the best
Yep.
ever. I believe there's going to be some snowboarding and skiing involved up in Keystone.
Yep.
So I'm really very interested in going into that. But tell us a little
Cool.
bit more about working with Joe.
Yeah. And I'll be at that event too in Keystone. So I hope to see you there. It was random. I was introduced to Joe Fairless through a friend of a friend after his conference. I actually didn't attend that conference that year. It was several years back. It may have been his first event. And just kind of met him in passing. My wife and I were looking at that time just to kind of diversify among sponsors. So we invest with a lot of different groups. We gave them a shot. We did just their minimum investment on one deal. And again, kind of just sat back, watched it. I had vetted Joe and the team out pretty well before doing that. I had quite a few word of mouth references. And the thing with Ashcroft Capital, it really just resonated with our core investing philosophy. My wife and I look for monthly cash flow. We look for value add multifamily, specifically in the B class sectors. We were wanting to invest more in Texas. We were wanting to invest more in Florida. And that was just 100% what they do and what they were doing at that time. And so it just really worked out to the point where we just kept doing, another deal and another deal. And so we're in 9 of their deals currently. And, as I'm in just my own networks, just talking among friends and family, people ask what I do and I share those experiences. And naturally, some individuals have an interest in doing the same thing. So I was sending Joe, people out of my network over the years as we were investing with them. And he just asked if I'd be willing to come on board as their investor relations rep. So basically, I don't do anything different than what I've always done. I attend a lot of networking events, conferences, real estate meetups for personal education, and the only difference now is occasionally you might run into me behind a Ashcroft Capital booth at an event.
Very cool. So what is it that you do? What does the investor relations director do for Ashcroft?
Yeah, so it's actually not in the traditional sense of maybe what you might think of with investor relations, where you've got, thousands of people that are, where's my distribution, or, what new opportunity do you have, or I need to change my bank account, things like that. I'm actually on the more of like a boots on the ground type of guy. So I'm at conventions, I'm at seminars, I'm at networking events, and when people are there speaking about passive investing or have questions about Ashcroft or what they do, I'm just the guy that can help walk them through, their business model and the deals that they do and why I personally invest with them, and just kind of more of a Q&A type of guy.
And Travis, what are some of the needs that are fulfilled for you through passive investing? Like some people are in it for the tax benefits.
Yep.
Some people are in it for, the legacy. Why do you invest passively?
That's a great question. So I like to, I don't know if I coined this term or not, probably not, but time freedom is something I talk a lot about. And so time freedom is just the ability to do, what you want, when you want, as much as you want with your time. That's different for everybody. For some, it's I want to retire early and have more time, on the back end there. Others, it's just I'd prefer to work part-time and not full-time. I used to hold a W-2 job where when I was doing the single family, where I was working 98 hours a week in Colorado. I had an oil field job, and I was just in over my head. I thought, man, I'm going to die at 50. I didn't see a way that was going to be sustainable for me. So I just knew I wanted a little more freedom and flexibility over my lifestyle, to where, I could change it up and I could do something for 5 years that I found entertaining, and then just completely, shift gears and go this way now. And I wasn't obligated to, I'd worked my way so far up a corporate ladder that's like, man, I make great money now. I got the golden handcuffs. So time freedom's what I was always after, just flexibility of lifestyle.
That's awesome, man. Yeah, I think that's why a lot of us want to get into real estate or multifamily or syndication or whatever vehicle of choice. It's really so that they can go travel and do the things that they want to with their family members and their dogs, in my case.
Yep.
So for somebody that's looking at passive investing, so you've vetted a lot of people. I'm interested in asking you about the different things that you've seen from the different sponsors. You probably interviewed more sponsors than I can imagine.
Yep.
So why don't we go into that a little bit? What are the things that you look for in a sponsor or syndicator when they are coming to you? You probably get blasted by a lot of people say, oh, you're a passive investor, I need to talk to you, right?
I'm on a lot of lists, we'll put it that way. Yeah. Yeah, I certainly have. And I think that a couple mistakes that I made when I first got started in syndication is I put far too much emphasis on the pro forma itself with each group, right? I was looking at it like, well, this group over here has a deal that says it's going to return 8% a year, and this group has one that says 10. I'm going to go with the 10, right? That's a higher number. That makes sense. But without taking into consideration who's on the team, what's the track record of that team, what are they actually bringing to the table? Have they done this before? All those types of questions I was leaving out in the beginning. And what I found with that, with like inexperienced sponsors that we had invested with early on, me specifically had invested with, is the deals actually performed pretty close to the pro forma, right? So we're just a firm believer in the asset class in general and the markets that we were in, and blah, blah, blah. But what happened was communication got dropped, and, reporting was hit or miss. And, when I had things come up, like I had to change a bank account or swap a registration name or whatever it was from time to time, those inexperienced groups, it became a problem. Things were done incorrectly. Data was not entered accurately. I couldn't get a response for days, things like that. So nowadays, a lot of my vetting is through, it starts usually with like a word of mouth reference, right? Like I said, I get deals left and right and back and forth, but until I meet someone that says, hey, have you heard of this group? I've been investing with them for the last 5 years. They've been phenomenal. That's usually what kind of gets me started on the process. From there, I'll look into the group. I'll meet up with them in person if possible. I'll check out their deals. And if the markets they're in and the deals they're doing align with our investing philosophy, it's likely that, we'll give them a shot and at least do one deal with them.
Okay, so this first process of you giving somebody your money, kind of a scary thing, right?
Yeah, absolutely.
So what happens? They basically convince you that you should trust and like them, and based off of their track record, you decide to invest with them. And then what happens? So you receive your first distribution, or what is it like from the passive investor side? You give your money to somebody, and then what do you start receiving from that sponsor? What kind of documents do you get?
Right, exactly. Yeah. So with investing in syndications and being a quote unquote passive investor, there still is work involved, but it's usually 90% of that work is all on the front end. So it's doing your due diligence and meeting with the groups and checking track records and looking at deals and signing all the docs and the paperwork, the subscription agreement and the private placement memorandum and all this kind of paperwork that you have to get done, and then wire instructions and sending funds and all that. Then usually anywhere between maybe 30 days to 90 days after the deal closes and they funded it, you'll start getting distributions. And a lot of groups distribute like on a quarterly basis, but my wife and I look for monthly distributions, which is quite rare really in the space, but that's something that Ashcroft Capital offers. That's why we've continued to invest with them. One reason why. And so, yeah, so basically you're in it for the cash flow year to year for usually, again, it depends on the business plan, but usually let's say a 5-year period where they're going to be making improvements and raising rents and making the property a lot better, both for tenants and obviously for the investors financially. And then we're looking at a disposition or a sale of the property anywhere between 2 and 5 years, somewhere in that threshold there. And then you're going to have an equity pop, at the sale. So you're going to participate in whatever equity was forced into that property, in addition to the markets, hopefully, rising with inflation at least, things like that. So all in all, I mean, it's a great risk-adjusted return, in my opinion, for what you can get in other places. And so I was finding that I was making as much and sometimes more doing a passive deal like this than I was doing the active deals when I was investing a lot in Colorado and single family.
Okay, what about the complexity of waterfalls and hurdles?
Mm-hmm.
What does it make you think twice before investing with someone, or um, how do you look at that? What is it that does it make you nervous, or are you just like, hey, that's just part of it, that's what everybody else is doing? What are the things that go through your mind as an investor when you see someone approach you with that type of documentation that says, hey, up to 8%, you get the preferred rate, and then after that, we do a split, and then if we hit another tier above that, then we get a different split. Is that confusing? Is it simple? Do you just trust that they'll handle your money? what is your mindset on that?
It can definitely be confusing, especially in the beginning. That's definitely a conversation you need to have as a passive investor, with the sponsor, with the general partner. Typically, yeah, I mean, there's going to be a fee up front, like some form of acquisition fee, probably some kind of ongoing management fee as a percentage, and then some kind of split, like you alluded to, or some hurdle. Once we pay you the first 8%, then we're going to take 70%, or I'm sorry, 30% or something like that of additional cash flow to a particular point. If we sell it, investors get 70%, we get 30, whatever it may be. Everybody's different on the splits. But the way I look at that is I look for as many opportunities to put the investor interest first, right? So like you alluded to, a preferred return means that the investors are going to get the first, X amount of percentage, that the property produces before the syndicate group or the sponsor starts pulling their fees and their splits after that. So that's putting investors first as one example. And a lot of groups too, as an ongoing management fee, they're not going to take that fee until they've paid the preferred return to the investors. So that's also a nice touch there. And a big part that we look into, my wife and I, is that whoever's putting this deal together has their own money in the deal. Newer groups, that may be a smaller amount, and larger groups, probably a larger amount. But like with Ashcroft, Joe Fairless and Frank Rossler, they each put, I think, $100,000 each in each deal. Sometimes that's a higher number, but that's a nice alignment of interest, right? If that deal is going to go south, they're in it too, among their friends and family. So we look for a lot of co-alignment and, co-interest in the deals that we do.
Interesting. Okay, so what happens when a deal starts to go south? Have you experienced that?
I have in the short term, but thankfully the market had kind of lifted it up enough to be profitable in the end. But definitely got into, I think, 2 projects where distributions had stopped at a certain point. These were some of the earlier deals that we did with some other groups, and it was just kind of a mismanaged asset, and they weren't able to make the promised distributions. And the only thing they could come up with is, let's sell it and get rid of it, because at least there's some equity in it, and we're going to be able to pay everybody their pref and get out and exit. So every deal we have done, knock on wood, has resulted, being profitable. Not to say it didn't come without some challenges with various groups.
So I'd love to hear more about the challenges. What are some of the things that happened that you didn't like, or the way that they communicated with you that you didn't like?
Yeah. One group just basically never budgeted properly for a CapEx budget, capital expenditures. So they really had no reserves on hand. And about 6 months in after closing, they had several units that were burned in a fire, which was covered by the insurance, but did take some occupancy down and just made it harder for that property to cash flow and distribute. They were still kind of turning over the tenant base, so we already had a low occupancy in general, and there was just nothing there to back them up. So they had to quit distributing, and it took, I don't know, about probably 6 months at least to get that stuff wrapped up. And at that point, they still couldn't distribute the cash flow, and so they put it up for sale, and it was about another 6 months till we were able to sell it. So that was kind of a rough deal. It was supposed to be about a 5 to 7 year plan. And yeah, we ended up selling it like the 2-year mark or less.
So when you're first working with a new person, or in the past when you've worked with somebody new, what kind of, do you typically speak with the main general partner before the company allows you to invest? That's what my company does. So nobody can invest with us until they speak with the CEO. Have you had that experience?
Well, that's tremendous. I'm really glad that you guys do that, because that's hugely important to me. And there are several groups out there where that's not really possible. I mean, I don't want to name drop, but there's some well-known people out there that are so busy doing their thing that you don't really get the opportunity to speak to them. It's more like the investor relations side of the business or somebody else, maybe an assistant or whatever. And so, yeah, that's very important to me. I don't think I would invest with a group if I couldn't speak directly to the people putting the deal together themselves. They're obviously going to be the most knowledgeable, have the most insight, and it's going to make me feel best that I know who exactly is, controlling my money that I'm putting with them.
Now, have you looked at other asset classes? I know a few people that syndicate office and retail and hotels, some other groups that syndicate new construction. Have you considered any of those? What do you look for when analyzing what you want to put your money into?
Good question. Right now, where we're at with the market cycle, I mean, we're under the belief that, a recession's around the corner. Don't know when, this year, next year, couple of years, whatever. But we're very much interested in recession resistant investing. I don't like to say recession proof, but when we talk about multifamily and value add, we're typically buying something a lot of times off market, a lot of times at a discount, and a lot of times, cheaply purchased because it needs improvements. And then we're going to have an efficient way to make that a better property and sell it at a much higher price point. That could be related to almost anything. I mean, you could do that with a vehicle, and you're buying a salvage vehicle and restoring it. You just have more of a margin and more of a chance to be profitable in something like that. And everything that we invest in as far as real estate is concerned is stabilized nowadays. So it's cash flowing out of the gate, day one, that kind of stuff. Yes, to your point, other asset classes. We've invested a little bit in self-storage. We've done some alternative investments like ATM investing and some distressed debt funds that we were in and things like that. So it's not 100% multifamily that we do, but that's definitely the majority of our interest.
And that's because you foresee that would be the strongest of the asset classes that we previously mentioned to survive if there's a recession or correction upcoming?
Exactly. Yeah. So we're always kind of thinking, what performed historically well in 2008, the year 2000, any recession that we've had, what kind of fared through those. And I got to see, as I'm sure many of the listeners and you yourself have seen firsthand, what that last recession really did for individuals just generally in the stock market and in mutual funds and things like that. I mean, a lot of people got hit hard, even in owner-occupied homes, and so I was kind of in a weird position during that time. I was going to college and I had some savings, and it was all in the stock market. This was 2006, 2007. And I had actually, someone gave me Rich Dad Prophecy. So not Rich Dad Poor Dad like most people start with, but first book I read was Rich Dad Prophecy. And bottom line was we're going to have some big economic meltdown in the United States. We don't know when, but it's coming, that kind of thing. And so all I knew after I read that book was I don't want to be in the stock market. I don't know what I'm going to do, but I don't want to be there. And so I liquidated everything right before the collapse. And again, I didn't predict the collapse or anything, neither did the book, but I just knew I didn't want to be there. And so I was able to preserve that capital through the recession. That's why I got started when I did in 2009, as I saw the asset prices drop 40% in my local market. It was seemed like a pretty decent opportunity to get started then. So,
and what happened in multifamily in the types of apartments that you currently invest in? Let's say they're probably 100 units plus, right?
Exactly. Yeah, probably 200 unit to 600 unit. That's kind of our ballpark range. Yeah.
So do you know what happened to those types of apartments, how they fared during the last major economic recession? We're talking about 2007, 2008, 2009.
Yeah, exactly. Yeah, as far as the actual statistics, it's like, I don't know, I'm making this up, don't quote me, but it's like 4% of multifamily, defaulted during the recession. It was very low comparative to like single family as an example. many reasons for that. Diversified tenants, instead of having one home and one tenant, and that person loses their job. Now you have nothing, that kind of thing. You have, 600 units. So 25 of them can lose a job and you're still cash flowing. You're still positive. That's a big part of it. Affordable housing is a big part of it. A lot of people that are living in luxury and high end and things like that can sometimes take a step down into the B class sector and things like that. So there's always kind of, some room there. Occupancy did dip. We just invested, my wife and I, in a deal in Irving, Texas, and it's like a 500 unit. And we looked, so one owner had held that for like 30, 31 or 32 years straight. So obviously they had gone through some recessions with it, never lost the property, always stayed cash flowing. But yeah, the occupancy may dip from, 95% down to 85%. But as long as your margin's still there, as long as that's still profitable when you're penciling the deal, it's just more conservative than trying to do a ground up construction, new development, something with no cash flow to back you up. So that's just our investing philosophy, but in
Cool.
general.
I've been speaking to these kind of cold call accredited investors. We have a marketing campaign that we're trying where if we have a deal, we put together a script and then give it to some virtual assistants. They call accredited investors and they give them a little sales pitch on the deal, and then basically, if they are accredited and they agree to get further information and they have a certain amount of liquidity, they get live transferred to me. So I'm taking these phone calls, and some of them are like they're sophisticated multifamily investors, and some of them they may be accredited, but they're definitely not people that I want to be talking to. They say things like, I see all the banks are going to collapse worse than the last time, and you're talking about this multifamily deal. Well, if people can't survive this recession and they can't pay their rent, then why would I ever invest in a deal with in multifamily, or with you for that matter? That's just crazy. And I try to explain to them, but they have this negative outlook of what's about to happen. At least some of the ones that I speak to, the ones that stick out in my mind, anyways.
Uh-huh.
But it's interesting. So do you think that people will still be living in these apartment complexes that you're investing in if there's a major crash? Or do you see actually, hey, there's people in nice places that are going to have to move into a place like the one that I have, so it's not really going to make an effect?
I mean, I always think it'll have an effect. I always look at, or try to look at, worst case scenario and think about that. But yeah, just like you said, I mean, some people are going to, take a step down from that 2,000 a month rent, to maybe a 1,400 a month rent, right? Because that's a little more reasonable, and maybe they don't, they had to take a pay cut, or maybe they lost their job, something like that. In addition, it's hard to afford to build, a B or C class product in today's market to make the numbers work. You see what I'm saying? To build a brand new apartment complex somewhere and then charge, $900 rent a month for the units is so hard to get a return on your investment. So there's a high demand for the existing affordable housing. And so that's why we're in the B class sector. I have also invested in C class apartments as well. A little tougher on the management side. So you want to make sure you're with a great firm that can pull that off. But I love those sectors, of multifamily specifically. So recession resistant, I'll stick with that as my term.
Very cool. So tell me about the way that you diversify. So do you invest in multiple markets with multiple syndication groups? What does that look like for you?
I do. So I have some of my own ideas on what I think about particular markets, right? I mean, I do a lot of research and I track migration trends, where people are moving and why, and reasons why I like particular markets, either because I've lived there or I understand them or whatever it may be. So I try to look for groups that are investing in those areas, and then they'll have their whole pitch on it as well. And so we invest with a lot of different groups. Again, mostly in multifamily. and mostly in the B class sector, and always with a value add component to them. But I've lived in Florida, I don't know, maybe 8 years of my life or something like that. And so I know a lot of those markets, and, we're invested there in Tampa, Jacksonville, Orlando. I think those are great places to be at this particular time. Also, we're big fans of a lot of Texas, not all of Texas, but a lot. And so we're pretty heavy in Dallas, Fort Worth, and things like that as well. So it's a very diversified economy there, and not any one sector is taking up, a huge amount of the overall market. So that's
What's
nice to have.
been cool? What's been your favorite syndication, like a specific property?
Oh man. Okay, I invested with a group in Glendale, Arizona. It's like a 300 unit. They went in, it was C class. They went in and did like a really, really heavy lift in a very short amount of time. I think it was about an 18-month project in total. And I think it netted the investors, after all the splits and commissions and all that kind of stuff, it was like a 40% return or something like that. So that was really nice in a year and a half. So being a passive investor, I mean, that was incredible. It's one of the first deals that I had been involved with. So that was really an eye opener. Kept me motivated.
On a heavy lift, though, you shouldn't expect to receive cash flow distributions, which is something that you're seeking, right?
Right. They were actually able to make their pref the entire time through cash flow, in addition to that overall return. So that was pretty incredible that they did that.
Yeah, that is pretty phenomenal. What about your worst deal? Was there stuff that can be learned from that for the person that may be interested in investing in a syndication for the first time?
Yeah, the worst deal that I did was actually in a fund. And ever since I made that investment, I haven't been too fond of doing a fund investment because it's kind of like a blind pool. You're going to put your money in. You're not really going to know what assets are going into the fund. You're not going to have control, right? You're not going to be able to say, hold on, I don't want that property, just all the other ones. So you're kind of stuck with what it is. I like going deal by deal. I like actually knowing the story behind a property, and what the previous owners had done and where it stands and all that kind of stuff. When you have 12 different things inside of a fund, I don't know. I don't like it as much. So long story short, that was a deal where the syndicate groups were doing a lot of external partnerships, and one of the external partnerships kind of really went south. And so it took the whole fund return down, and it was nothing in anybody's real control. It was uncorrelated. It was like, it was so far branched out that, what do you do? And so anyway, that was kind of a lesson learned from that. Nothing against fund investments. I think there's plenty of good ones out there. Maybe if there's just a few properties in it, or if what all the properties are going to be that are going in it, that's cool. But I don't like going in blind and, just giving someone your money and saying, do whatever you want to do. I don't know. We'll see what happens.
From what you're seeing now that you're working with Ashcroft, well, maybe not necessarily do with Ashcroft, but do you believe that one bad investor can poison the whole lot of investors? Is somebody just, what would that look like? Have you seen that? Have you experienced that?
I haven't experienced that per se. So a lot of groups will have a minimum investment and then a maximum investment. And the maximum is to try to, prevent that from happening. I mean, that's one tool that you can use. So if you had a large investor try to ruin the deal for everyone, or they needed their capital back, or whatever it is, I would hope that the group sponsors would be able to backfill that individual somehow with a raise of capital, right? To kind of buy that person out, or to go to the existing investors and say, not like a capital call, but just, does anybody want to pitch in an additional, 25K or 50K or something, so we can make this thing happen. But I haven't experienced it firsthand, so I don't have any stories to share. I know plenty of limited partners that have needed capital back for various reasons. these are obviously illiquid investments for the business plan time frame, right? So don't expect that you can just call and get your money back, for 5 years if you're doing a deal like with Ashcroft. But it does happen, right? People run into some medical issues or things come up, and it's understandable, but often they can mitigate that with the buyout purchase. So
Very cool. What do you think would be the best advice that you can give to somebody that's wanting to passively invest? What should they look for in a sponsor, or what should they look for in deciding what they invest in?
the best advice that I wish I had was to really vet out the team. I mean, really take the time, right? Don't get in a hurry. Don't just say, I don't have time to read these emails or look at these docs or whatever. So here's my 50K and, that's that. Because you're going to be in that deal literally in a relationship with those folks for 5 years, and it could be 10 years. If we have to hold it longer or we go into a recession, we don't want to sell right now. It could be a very long-term thing. And so don't rush into it. Don't try to skip 2 or 3 days of due diligence or something, for a 10-year, pain in the butt.
So what do you think about these guys? I don't know if you come across them, but they've invested passively in the past, but now they're kind of backing off and saying, I think there's a lot of people that are going to cause like a bust or a bubble burst or a boom in syndication, because there's all these inexperienced operators, and some of them may be over leveraged. And when the climate changes, there's going to be a lot of people that lose, and they're sitting there on the sidelines waiting to purchase these properties that will be distressed, at that
Mm-hmm.
point. What do you think about that? Should they continue to wait, or what's your take on that?
Personal philosophy, personal choice, and yet another reason why we like to vet out each deal individually. I mean, there's so many deals that I pass on because I feel like it's aggressive underwriting, or they're going to say, hey, the market's going to go up 5% for the next 5 years. I don't like that type of stuff, and again, back to like the funds and not knowing what's going in them, that's a lot more sketchy to me. And it's harder to underwrite for. It's harder to understand. So you just have to be, the deal literally has to make sense in today's environment. Okay, I don't look for big projections on rent growth. If it's here's what I like to see. I like to invest in a property that's currently today $300 a door below the market rental rates, and the business plan is to raise them 125 a door in 5 years. That's what I like to see. I think that's more than reasonable, and it gives you some margin. If you do exceptionally well, you could maybe bring it up to 250 or 300, possibly, and then you can exceed your pro forma. I don't like 300 a month rent raise in 12 months. That's a little scary.
What about the difference between joint venture on 100 units plus versus syndication on 100 units plus? In the assets that you like to invest, do you see anybody joint venturing, taking those down?
Not many. I mean, you've got your larger players out there that'll structure it like that. Like I don't know, like a Robert Kiyosaki or somebody. They may partner with just one other person and take down a large asset like we're investing in. But and unless you've got several $1 million to play around with, which you may, and you want to put that all in one deal, it could be lucrative. But for a lot of people, what we like to be able to diversify, my wife and I, with 25K and 50K and 75K increments. So a little bit in Dallas, a little bit in Orlando, whatever, a little bit in Atlanta, and just kind of spread that all around among different groups and different geographic locations. But we're not at the point where we're $500 million to play around with. So that's why we do it.
So do you see anything? I want to ask about minimum investments. Do you see opportunities that are like $250,000 minimum, or some people will take it down even smaller? You see these online automatic raises that have, regulation A, $500 minimum
Yeah.
investments. What's your thought on the minimum investment?
Well, my thought is even back when in 2009, knowing that I wanted to be passive and knowing how much money I had at that time to work with, I wouldn't have just jumped into the passive game because I know me and I wouldn't have been motivated if I was receiving $50 a month in passive income. That just wouldn't cut it for me. It just wouldn't have been enough to keep me propelled to keep going and building and building. So I wanted to have enough capital and, accreditation status first to be able to get into, the passive opportunities where now you're looking at, 1,000 a month here or 1,500 a month there. And, numbers that actually would motivate me to stay focused on it. So, I mean, you definitely can get in these non-accredited opportunities out there with various groups and crowdfunding and whatnot, and put in $500. But if you want $2 a month cash flow, then you know, I guess go for those.
And what
So,
about on the high end? So we actually
yeah.
considered doing raising our minimum from 100,000 to 250,000,
Hmm.
just so that people could talk us down potentially to 100,000 in some cases. I think we're
Hmm.
still kind of open on it. I think if someone comes up and says, "Hey, we have 100,000," we pretty much would like to talk to them. But in terms of creating that, it's harder to get in.
Hmm.
So, what do you think about that mindset or that psychology from certain?
Well, I think personally, you're going to attract a more sophisticated individual, right? More of a heavy hitter. A lot of groups that I've seen that have 250 or higher minimums are looking for institutional capital, family office money, things like that. So it's just a different strategy. I mean, are you after the individual accredited investor or the individual non-accredited investor or the institutional capital or the family office money? It just depends. But that's what I've seen in my experience. And just me personally, I don't like to put any more than 100 into any one particular deal. But that's just me. So maybe I wouldn't be your target demographic in your deals. So
It's been a lot of fun stepping into the mindset of a passive investor. Is there anything else that you want to share about the passive investing or about Ashcroft Capital before we sign off?
sure, yeah. So I've got a passive investor guide that's got a lot of terminology, how to vet markets, how to vet deals, how to vet sponsors. It's like a 20 pager, so pretty dense material. That's free, so you can get that at ashcroftcapital.com/passive investor. And if you guys want to reach out to me and just, I'm always open to talking real estate. You can reach me by email. It's probably best, Travis@ashcroftcapital.com.
It's been a blast having you on this show, man. I hope to stay in touch with you. And so, are you a skier or a snowboarder?
Skier, actually. Yeah.
Okay, cool, man. If I go up to Keystone, we'll definitely hit the slopes together. Maybe have a drink inside one of the ski chalets or something like that. That'd be a lot of fun.
Yeah. That'd
Hopefully,
be
we can
awesome.
connect, shake hands, and then hang out a little bit more. It's been great having you, so I appreciate that.
Sounds good. Thanks so much, Ruben.
Cool, Travis. Enjoy the rest of your day.
Same.